Welcome to the quarterly update for the Fund Finance Association. My name is Tina May. I'm a partner and head of fund finance at the Maples Group in the Cayman Islands, and I'm vice chairman of the FFA board. Thank you all for joining us today. I'm excited to hear the panel discussion, and as always, we welcome and encourage your feedback on the topics discussed, both today and any topics of interest you think are relevant to the global group going forward. Please take the time to complete our short feedback survey, which will be circulated later today. Before I get into the details on the panel itself and the topics being covered, I wanted to formally acknowledge that April is Diversity Awareness Month, and we, the FFA, are committed to advancing inclusion, equity, and diversity in the fund finance market. I'm proud of all the initiatives that have been commenced by the FFA, the Women in Fund Finance, the Next Gen committees, and also more recently, our Diversity in Fund Finance committees, each across the globe. We stand against all acts of hatred and violence, and we strive to achieve diversity and inclusion in all that we do and all initiatives that we support. 40% of our board members are women and 20% represent racial or ethnic minority backgrounds. I'm extremely pleased today to announce that Danielle Roman has been appointed as our newest board member. Danielle is a known figure in the industry, and she plays a significant role in the fund finance industry in the Asian market. We're extremely excited to welcome her to the board. Today's quarterly update is going to discuss many interesting topics, including current trends in the market, the impact of the impending LIBOR transition, and the impact of potential fraud on our industry. We're extremely lucky that the fund finance market and product lines are secure, commercially flexible, and robust, even in challenging times. The last year or more of the pandemic has given the entire world markets a challenge, and fund finance has continued to progress, adapt, and prove itself to be nimble in the face of all of these changes. The market is showing no sign of slowdown, and instead is simply evolving in the face of changing demands of banks, sponsors, and investors. One constant challenge that all product lines face in the financial markets is fraud. We cannot prevent fraud, but we can look to address and protect against any risks that may exist, taking into account all of the market factors, its sensitivities, and the deep commercial relationships that are in play. The panelists will today take a look at these relationships, our products, and what, if any, lessons can be learned from the last year to protect the industry and all participants going forward. But first, and before the panel is started, I'm now pleased to pass you over to my fellow board member, Mike Masher, for the pre-Queen update.
Hey, this is Mike Masha. I am pinch hitting this morning for Terry Hatton. Terry did a whole bunch of work getting today's event organized, and we appreciate it, but unfortunately had a personal situation and couldn't join us this morning. So Terry, best wishes and thanks for all you've done. It's great to get to address the market when there's a little bit of optimism in the air for the first time in a while. Business has been continuing on pretty good for many of us. The equities markets are doing well, and second vaccines are starting to happen. So it's a good time to get to visit with everybody. I'm pleased to get to introduce today Raman Mani, who's the Associate Vice President at Preqin. Preqin's just been a great partner to the FFA for years now, and Raman's going to give a data dump on how fund formation has been going so far year to date, as well as a look back at 2020. We will have an opportunity at the end of his presentation for some Q&A using the Q&A function on your Zoom screen, so please feel free to submit questions. Raman, thanks so much for joining us. We're glad to have you.
It's great to be here, Mike, and just want to say thank you very much to FFA for having me down. Looking forward to giving you a private capital market update. So let me just share my screen. Hi everyone. So again, thank you for coming along, virtually at least. I'm going to be covering a private capital market update, which will be including a look at dry powder, the fundraising environment, how private capital performance is compared to public markets, as well as the outlook for private capital over the medium to long term. So just a brief overview of Preqin. We're the leading alternative assets data provider. So with data solutions and insights for alternative asset professionals, we have over 110,000 subscribers across 32,000 firms worldwide, and we have offices based across the world. So I want to start off with dry powder and AUM. And I think it's one of the more astonishing figures within this presentation. So what we're highlighting here is the tremendous growth of alternatives AUM. These figures here include all of private capital. So that's private equity, private debt, real estate, infrastructure, as well as hedge funds. So we can see here that in the past decade, AUM has nearly trebled from 4 trillion in 2010 to almost 11 trillion in 2020. Quite astonishing growth. But I think what's even more great is the forward-looking forecast that we have, that by 2025, alternatives AUM will top 17 trillion. It's quite the dramatic figure for the so-called alternative sector. That figure, by the way, is from our 2025 Futures of Alternatives report. So we have, based off our own samples and our conversations with GPs, as well as a lot of work from our data science team to go into that. Now I want to look at the growth of private capital by asset class. So over the last decade, private capital AUM has grown from 2.7 trillion at the end of 2010 to almost 7.5 trillion midway through 2020. So this equates to quite a rapid compounded annual growth rate of over 11%. But I think what's probably the most interesting aspect for us right here today is that this growth rate has been increasing over the recent years. So for the previous 5 years, that's a 78% growth rate in private capital AUM, whereas compared to the first 5 of the decade, where it was a measly 54% growth. Private equity has been one of the key drivers of this growth. With a market of over 3 trillion increase in AUM over the last decade, it's currently accounting for around 2/3 of current AUM. These inflows to the alternatives industry from investors, coupled with returns expected from it, means there's been a meteoric rise in the cash pile sitting with private capital. Dry powder currently sits at over $3 trillion. So that's roughly the same as the market caps for Apple, Amazon, and Facebook combined. Not a bad little buy-in spree if you can get your hands on that money. So now I want to touch on the fundraising aspect of it. You would think with all of that dry powder currently in the system, increased competition for assets, you'd maybe think that some firms might take their foot off the fundraising pedal to make sure that they can put that capital to work. And even more so after the 2020, which we've just had, you think there might be a pause just to take stock of what's really going on. 2020 had other ideas. Another $1 trillion fundraising for private capital. I mean, that's highlighted by 650 billion for private equity, and then 144 billion in real estate. Some truly staggering numbers. Now, although there seems to be an incredible amount of capital to go around, that isn't quite the case. So what we're trying to show here is the key trend over recent years, and that's the continued capital consolidation towards the bigger players. So as highlighted here, in 2011, only 20% of capital raised was by funds over 2.5 billion in size. If you fast forward to 2020, that figure has over doubled to 42%. So when we look at 2020 as a whole, there were some mega funds raised over, with CVC and Brookfield Infrastructure both raising over 20 billion. And I think what's quite interesting about one of the mega funds raised was that Arjun raised 19 billion for a secondaries focused fund, which shows that investors really do have an appetite of not just diversifying amongst alternatives, but it's the style of returns that those alternative investments can provide. The bigger funds are taking an even larger slice of the pie, which has obviously meant a tougher fundraising environment for those smaller to mid-sized firms. That's what we're showing here with the 100 to 499 million bracket, which in 2020 accounted for 16%. So there are a few explanations about this kind of shift we've seen over the last 10 years or so. Obviously, with the size of private capital increasing over the last decade, there's an increased capacity for those larger vehicles, as well as the tendency for the more experienced firms to raise larger and larger follow-on funds as they do gather that experience and that LP relationship begins to foster and grow. But I think taking into a deeper look at the first time funds, we can see it's really not that easy a time for them. So first time funds usually account for around a third of all funds closed across private capital, But in recent years, that percentage has been falling. 2019 and 2020 were particularly tough years, dropping to around 20% of number of funds closed and below 10% for aggregate capital. This might seem all doom and gloom for the first time or emerging managers out there, but it's not the case. Last year alone, there were 20 first-time fund managers that raised over $1 billion in equity. So what we're seeing is first-time fund managers need to just try and differentiate themselves amongst that crowded competition, and there is still the capital there for them. So I now want to take a little brief look at some of the deployment of capital. So with levels of dry powder, as I've mentioned, rapidly growing over the last decade, deploying capital has become an even more competitive landscape. So what we're looking at here is purely just private equity backed deals, so not the whole of private capital. There's been a decline since 2018, where there were almost 7,000 deals completed for around $550 billion in aggregate deal value. 2019 and 2020 showed similar levels across a number of deals completed, as well as aggregate deal value. I think that's quite an impressive number for 2020, looking back at the year we've just had. So I wanted to take a bit more of a dive into it. And when I did, Q2 2020, we saw a dramatic fall in the number of private equity deals. However, that pent-up demand, which caught up in Q4, right about the time when there was some loosening of restrictions because of the pandemic, they really shot back up and were able to get back on track. And as you can see, caught up with 2019 levels. From the figures we have here, we're kind of expecting a similar level of private equity deals to be completed over 2021 as there were in 2020. So now I just want to touch on one of the main reasons why we're probably all here today, and that's the outperformance of private capital. So what we're highlighting here are the returns of private equity and private capital as indices versus the S&P 500. So when we rebase that to 2000, quite clearly able to see this widening gap of outperformance over the public markets. But I think the question which we all want to know, and I suppose is probably the most interesting to us, is how long can that performance be maintained? You've got richening valuations across the market and increased competition, and that's just two of the headwinds which are probably currently facing private capital. Now taking a closer look at the risk return profiles across the asset classes. Each bubble here, the size of it shows the market capitalization of its respective asset classes and its standard deviation of returns plotted against the median net IRR. So that's quite a lot to take in. Hopefully it should come as a fairly intuitive chart where you have private equity being the largest bubble as well as the furthest right. So they're still looking at the high absolute returns for private equity. But I think it's interesting to see real estate bridging that gap between private equity and then maybe more the slightly downside protective natures that you get of private debt and infrastructure. There is also the slight outlier of natural resources, but they are the alternatives of alternatives, so to speak, and they're a fairly niche investment. So, having spoken about performance, deal flow, and capital raising over recent years, I now want to look at some of the more forward-looking aspects of private capital. So starting with the chart on the right, we can see private equity, private debt, real estate, and infrastructure, that around 50% of investors will be looking to increase their allocations to the asset classes over the longer term, with only around 10% for the same four asset classes saying that they're going to decrease their allocation. So this just kind of reiterates and showcases the growth that we've seen in AUM and capital raised that we do expect to continue. The two asset classes which maybe have fallen below expectations are natural resources, which, as I mentioned, is still a fairly niche investment within the alternative sector, and then hedge funds. So which have over the last few years maybe lost some of the shine that they've held with investors, be that from performance or fee structures, etc. So from that chart, investors seem happy to allocate more, or they're content in their current position. Well, what's driving their allocations? So looking at the chart on the left, being labeled as alternatives, the top reason for investing in them shouldn't really come as a surprise. It's diversification. However, I think one of the more interesting things here is that in amongst the headwinds, high absolute returns is still the key motivation for investing within private equity. Now I'm going to look at a couple of the hot topics, so to speak, that we're seeing amongst private capital. One of the hot topics we're seeing in the investment industry as a whole, not just alternatives, is ESG. What we're seeing from investor and fund manager conversations is that all participants are being asked more and more about ESG and their ESG capabilities. This is highlighted by both charts, with 43% of investors seeing a significant increase in demand for their ESG capabilities, as well as their own shifting views on how important ESG is within decision making. So from the chart on the left, we're seeing 37% of investors viewing ESG as extremely or considerably important. And for the last one, I want to focus on maybe some competition within the market, as well as some a new topic that we're currently seeing. There are over 4,200 private equity focused funds in market, targeting roughly $900 billion. So that's a lot of competition for capital, as well as deals, just within kind of their own space. Yet now what we're seeing is the rise of SPACs. So looking at this chart on the left is actually, I still kind of can't quite believe it, but there have been more SPAC IPOs in this quarter just gone than there were in the whole of last year. So, and their current gross proceeds are around $100 billion. So roughly a tenth of the size of the private capital being marketed by private equity funds. But I think what's interesting, from our survey in November, 2/3 of our respondents said, no, SPACs have had no impact on them so far. But I think looking at the current trend of IPOs and the amount of capital that they are raising, there has to be some change within that, because they will be competing for similar assets and it has to have an impact. So just as some summaries and some key trends, we've got $7.5 trillion in AUM for private capital. That's forecasted to rise to 13 trillion in 2025. Capital consolidation is occurring across all asset classes and they're flowing to the larger, more experienced managers. Performance is largely meeting or exceeding investor expectations, which is then driving that increase in investor commitments over the long term. So I think we're going to take a look. Sorry, that's the end of the presentation. And I think we're just going to take a look and see if there's any Q&As coming in. And I think if there's some coming in, perfect. Hi, Mike.
Yeah, so let me start, Raman, if you don't mind. Thanks for that. So on your slide 5, looking back at your growth predictions for the next 5 years, they're ambitious. And, you know, I think you've been proven right on some historical ambitious projections, but they are ambitious. You know, can you give us some thoughts about what's driving that? And maybe, you know, do you think if the growth in the SPAC market continues, that those projections might end up being a little rosy?
Yeah, of course. I think one of the bulk of the AUM growth that we've seen across private markets is expected to take place from the growth from the Asia Pacific region. So we're predicting that their AUM of the region should increase from 1.5 trillion, I believe it was in 2020, to a little under 5 trillion in 2025. So you've got the twin factors of lower current penetration rates, and faster GDP growth than more established markets. That would really attract kind of the significant interest from both investors and fund managers. So we do expect AUM to be strongest within private equity itself. Private equity assets have displayed their resilience during times of economic stress and have generated returns superior to other asset classes. So yeah, with the market less mature and fast growing Asia, there's a large proportion to come online there. Oh, Mike, I think you're muted.
Raman, are you able to see the audience questions?
Oh, yes, sorry. The rise and rise of ESG. What is the investor base that has answered this survey? What countries? Sorry. So that was done from a survey across all of our investors that we had. I think it was across the regions. I don't have the exact ones there, but it wasn't one specific country that we targeted. It was across all of our investors. It's something which I can definitely look into and provide the exact makeup for that survey after the presentation can be sent out. And the first one is Preqin aggregating ESG metrics, whether gender and diversity or other ESG metrics. So the survey itself is quite a qualitative one. So there are many questions and then we aggregate based wholly of that. So we don't have the specific answers on those, but again, something which afterwards I can definitely share the report that we had for that. Lovely. We have one more come in. Does Preqin have a feel for the SPAC sponsors and degree of overlap with existing sponsors contained with the private equity AUM? So it's definitely something that we're starting to see more and more of. We're getting asked a lot more questions from our own subscribers about the market that we see. There is a lot of fever around them. We don't have any hard figures as of yet about kind of the degree of overlap. So maybe from those larger PE firms, but it's something which we will be taking a look into and kind of making sure that we see. Do you have a trend of information on private equity as a percentage of institutional asset allocations over a similar time horizon? Which asset classes are declining? So in general, we've seen kind of more of the institutional, kind of the longer term investors come online and start to allocate more and more towards PE. Well, I don't have the exact figure to hand, but it is something which I can remember from our general trends, it has been an increasing figure. I know from over the last few surveys that we've conducted, hedge funds, as I mentioned, have had a little bit of the shine taken off. And although in general, more investors still want to allocate more, that percentage is decreasing, and there is a higher percentage of investors seeking to remove assets from hedge funds and reallocate amongst others. But yeah, so hopefully I've been able to answer that one.
Great. Well, to keep us on schedule, Raman, we're going to have to stop with the questions there. Thanks so much for joining us. We appreciate you and Preqin supporting the Funds Finance Association and hope to have you on another program here again soon.
Yeah, perfect. Thank you very much for having me again. And yeah, look forward to doing the next one, hopefully.
Great. And so with that, thank you all for joining us, and we'll move on to the market update panel.
Thanks, Terry and Raman. Everyone always appreciates the update from Preqin. My name is Jeff Johnston. I lead the corporate investment banking practice covering asset managers at Wells Fargo, and also the chairman of the FFA. With me today, I have two esteemed panelists joining me to talk about what they're seeing in the market. First, we have Jill Wilson, the Global Head of Financial Sponsors at Lloyds Bank, and Sammy Asoli, the Global Head of Subscription Secured Finance at SMBC. Thank you both for being part of the FFA market update, and hope you guys are doing well. I know there's a lot going on in the market, so I think we've got a lot to talk about today, and it's pretty amazing to think about. We've been in a mostly work from home environment for just over a year now. COVID has dominated everyone's life, yet the industry seems to keep chugging along. And most people I'm talking to are saying we're as active and busy as ever. But now more than ever, and certainly over the past 12 plus months, I feel like there's more optimism out there. Certainly we're not out of the woods yet, but the combination of vaccine rollout, warming temperatures, starting to talk about going back to the office in the not too distant future seems to be, emanating throughout the market and creating some positivity. Today is also opening day in Major League Baseball for Tampa Bay Rays fans and folks out there like me in the US that are excited around that. But, Sammy, I hear that you've had some personal experience with a vaccine. How is that changing your perceptions on things out there today?
Well, Jeff, I'll give you a short-term view and then I guess a long-term view. In the short term, it's awful because I'm on my second day now after my second dose, and I'm battling an on and off fever, and frankly, just been incredibly exhausted. So, there's a part of me that's wondering, why I went ahead and did this, but no, actually, in all seriousness, very excited. First of all, New York City feels alive. The it's getting warmer. People are outside. There seems to be, a lot of activity. It's obviously a welcome change than what we saw last year. So super excited about that. And more importantly, I'm seeing a lot of people at the bank get vaccinated. We're all excited to kind of get back together, frankly, celebrate a successful 2020, but also, celebrate what is, I think, an outcome of, resilience over a once in a lifetime epidemic. So super excited about that.
Yeah. And Joe, what about you? The UK had a much stricter lockdown recently than what we experienced in the US, but sounds like you guys are coming out of that and opening up. How's that feeling?
Yeah, thanks, Jeff. It feels good actually. Yeah, it's felt like a long time since before Christmas. We've been under quite strict lockdown restrictions, as you know. So it's actually as early as last week, beginning to lift those, and it will happen. A really good sense of optimism from everyone, really. So that's good. I think the vaccine program, is going well in the UK as well, and the weather's getting better. So I think all those three things combined, and it feels good. Yeah, and I think we're beginning to think about, when can we get back to the office and when can we start meeting in person again? I think there's another way to go there, but even be able to talk about that and think about that, I think is hugely positive. So yeah, definitely sense of optimism as well. I think it feels like we've come and turned a corner from the winter months, and hopefully outlook continues to be positive.
Well, that's great to hear. It even caused me to shave for the first time in 2021 yesterday. So, turning over a new leaf. Now I just need to figure out how to lose some weight so I can fit into my suits, so we can get back into the office and normal attire. Maybe moving on to market observations. Let's start a little bit with talking about closing out of 2020. We had the bigger FFA virtual conference in early November, but I think a lot happened between then and the end of the year. Jill, maybe why don't you kick off and tell us a little bit of what you observed finishing out 2020?
Yeah, happy to, Jeff. And I guess really where we closed out 2020 was really a continuation of some of the discussions we'd had in the second half of the year. And actually, I think, we might come on to discussing Q1, but continuing to see sort of consistent themes and acceleration of those even as we come into this year. So I think all the things we were talking about, fundraising remaining really resilient and robust, remain true. Investor demand seems to be really, really strong still for private market funds. We're seeing many of our managers successfully raise funds in their core strategies, but I think what we're seeing again at the end of Q4 and into Q1 is, we'll focus on broadening those strategies and continue to deepen sort of multi-strategy platforms. And that's just driving, demand, in terms of fundraising, but also in terms of fund finance and facilities. So, we saw a strong year to the end that sort of spilled over into Q1. I think combined with that, we're seeing deal activity, being good and starting to pick up nicely. I think we're seeing M&A activity, strong and beginning to get stronger. That's also obviously helpful for us and in terms of our utilization of our facilities. It's interesting that Q1 tends to be a little quieter period and probably a low point in those utilization, but just looking at those levels, we're really starting to see those pick up nicely. That's a good indicator, I think, of M&A. So, I think we start to see in Q4 discussions with clients around, secondaries transactions. I think we talked about, at the end of last year, I remember the Preqin presentation around the strength of fundraising in the secondary space. And I think we're starting to see that. We started to see that, start to flow through in Q4 and again into Q1. So, yeah, I think, it was a really busy year. I think we were all pretty tired by the end of the year. It wasn't an easy year to navigate, but I think collectively as a market, we've done really well. We did really well. I think, as a bank at Lloyds Bank, we did really well. It's not been easy for any of us, but I think, we ended the year feeling, reasonably positive.
Yeah, that's great. Sammy, what about your perspectives?
I think, Jeff, probably, very similar theme. 2020 was interesting. I think, for SMBC, it was a record year in terms of deal volume, but it was also a record year in terms of syndications activity. And it's interesting, the velocity of the balance sheet was significant in 2020. That's going to continue to be a very big theme for us as we think about the efficiency of balance sheet over the next few years. But from a deal perspective, I mean, clearly we saw a major uptick really when the COVID crisis hit, and it became very clear what was happening in the market. I think, a lot of investors thought about their liquidity needs, and I think were uncertain as to what the future looked like. So we did see an acceleration of transactions. And I think, at a time it was interesting because it almost became slightly price insensitive at that point as well. It was, let's get the deal done, let's get that liquidity in place. And because of that, we saw such an incredibly busy summer. And I'm sure that's a theme with a lot of people. The reality is, the demand for the product was there. I thought there was a little bit of a supply-demand imbalance in the beginning, and I think that presented some unique opportunities for us. I don't necessarily think that any bank pulled out of the business or thought that, they didn't want to do it, but certainly there was a pause with some banks. And because of that, it afforded us the opportunity to step in and really win some pretty notable transactions. So ended the year strong. I do think, an interesting observation, I was going through my notes earlier, and there are some unique asks that came in 2020 that I think were probably a function of the environment, largely around SMAs and some kind of unique mandates that were being put in place as a reaction to what we were seeing in the market. So dislocation funds or opportunistic investors looking to put a single mandate in place and subsequently secure financing for that. So that was also an opportunity for us, and we closed a record number of those opportunities in 2020.
Yeah, no, that's great. And it certainly it feels as if the calendar turned into 2021, and a lot of the fundraising shifted from opportunistic strategies, and a lot of the largest fund manager complexes that were very successful in raising capital, but where some of the others didn't necessarily adapt as quickly or couldn't raise as much in a Zoom environment. It feels like those phone calls have been coming back in, and some of the people that we thought would have been raising capital in 2020 are coming back into the market, and it feels that everyone now is functioning in this environment and able to continue going forward. So what have you guys seen in early Q1, Sammy, and how is that a little bit different? Are you seeing the same thing that I am of the number of managers that are looking to put facilities in place and likely to close on funds increasing?
Yeah, definitely. I think I mean, clearly that's there's been an acceleration of that, particularly now that I think that people are seeing, what I consider to be light at the end of the tunnel, and I think markets have stabilized a bit. But I think actually something unique that kind of ties into 2020 that I've seen is that it's the subsequent fundraises and really the upsizing of facilities that I'm now seeing. So what I do think, and again, I'm somewhat speculating here, but I think that a lot of managers wanted to accelerate those first closes to at least get a facility in place, albeit at a smaller size, maybe on a bilateral basis, on the basis that they also knew that there would be a subsequent fundraise coming into 2021, which probably was delayed as a function of what we saw in 2020. So we really, were very much active in bridging to that permanent facility. And now what we're effectively facing is a significant amount of volume in terms of building syndicates and clubs to actually get the permanent financing in place. And I think that's been an interesting feature as we transition into 2021. I should say, I'm going to keep saying as we transition. Today is the first day of the fiscal year for SMBC. We're on a Japanese fiscal year, so I'm sort of losing my sense of timing and treating April 1st as the first day of the new year for us. So
yeah, well, happy New Year, and we'll continue to balance that. Jill, what have you seen more recently, and anything materially different in 2021 so far versus 2020?
Yeah, so I concur with what Sammy said. I think demand for facility to support fundraising, definitely they're upsizing. Definitely seeing that, and I think that's again. I think the point Sammy made about getting the first closes under the belt, and then looking to upsize later. I think it's also being driven by that M&A activity that we've seen start to pick up as confidence has returned. And I think it's not just on new fundraising. I think we're starting to see some of that sort of innovation and utilization of fund financing facilities for other purposes, and sort of thinking and expanding that thinking about how they could be used. Definitely a feature, and I think that's COVID has accelerated that. So, many more discussions with clients around, how we can support, later stage funds, crystallizing liquidity or supporting follow-ons. So, some more sort of nuanced discussions as well. So, I think that's a flavour that we'll continue to see. I think the other end, I mentioned secondaries. I think that the levels of conversations have already picked up in Q1. For us over here in the European market, ESG is the other element that's just, if I was to differentiate Q4 versus Q1, that would be my single biggest sort of shift, if you like. The others are a continuation of a theme. I think ESG, we were talking about it in Q4, and obviously there've been a number of transactions, but, relatively few last year. The number of conversations that we're having with clients, and across syndicates, has just, intensified and increased, multiple times over. So that definitely for me is a sort of a step change from Q4 to Q1.
Yeah, and you hit on two things that I'd love to dive in, a little bit more, both the utilization comment and around ESG with larger, syndicated facilities, and that being a newer topic for a lot of banks. But maybe first on the utilization piece, we've certainly experienced, the same thing that you have, to where it might not be all-time highs, but it's probably sustained higher levels of utilization that have continued to uptick, candidly for the last, 6, 7, 8, 9 months. Now, it might have been all-time lows in second quarter of last year when, deal volume ground to a halt, but we've kind of passed the norm, and certainly at the upper bound of what we think of is the normal ranges. And, I'd certainly point to the same thing that you did of level of M&A activity and other uses, as being a driver to that. But you bring up an interesting point, and as more sponsors have figured out unique ways to use these lines, should we as an industry, anticipate, a step up in utilization, or, do we think it's more of a just a function of all the activity and volume that's going on out there? And, love your perspectives on that. Maybe Sammy, I'll pivot it to you first, since, let's, I guess, see whether or not that's, that phenomenon is something that you guys are witnessing in the space first too.
Yeah, no, definitely, definitely a common theme. Utilization has ticked up. It's not at an all-time high, but certainly, higher than where it's been. But I also do think it's obviously a function of the asset class, and it's also a function of the portfolio makeup. So, to the extent that you have, a significant amount of, aftercare facilities and these things, I think I'm much more sensitive to that these days than I was. For me, utilization has also become a question of obviously cost of capital and the efficiency of the balance sheet. And that's become, increasingly important because, we obviously don't have unlimited resource to grow the portfolio as we wish. But it's certainly something that we continue to monitor. And I do think that there's an evolving discussion as to how these facilities are used. I think more so than ever, some of the client conversations you have, when perhaps you used to ask such a binary question, hey, are you using this as a form of leverage, or is this, purely just working capital to bridge that, the capital call? And really the answer is, well, any kind of treasurer or CFO is going to look at this and say, well, wait a minute, this is, it's much more dynamic for us. And, this serves, multiple purposes. And because of that, and I think because of the efficiency of the tool, you are seeing those utilizations pick up. I guess the last point I'll also make on that is we've been a little bit more aggressive as well to have conversations with clients about, how much facility do you actually need? Does this need to be this size? Here's your historic utilization. So, let's find a way that makes economic sense for you, because while it's nice to have that liquidity in place, there are alternatives, and, there's other ways that we can think about, the right structure and the right balance. So that we can continue servicing. So that's also, I think, plays a part in it as well.
Yeah, that's a really good point. And Jill, thoughts? I mean, are you projecting, as you think about it, kind of maintaining these levels, or any directional trend on a go forward basis?
Yeah, I'm not sure I have an answer to that at the moment, Jeff. I think it'll be interesting to see where it goes. I don't think it's at an all-time high. I think it's pleasing, to see after 2020. I think it's good for a Q1 period as well, where it can sometimes take a little bit more time for those drawings to ramp up. So I do think it is driven by M&A activity. I do think Sammy's point is a good one, in terms of we've had similar conversations around that sort of day one facility size, particularly where it's first closing. Does it need to be that size? So it's a smaller facility that gets utilized, a little bit more and steps up when it's needed. And that step up decision has tended to be supported where there's, increasing deal activity. So there's a bit more line of sight in terms of stepping up where there's sort of that deal activity, to drive that sort of more solid utilization. So that's an interesting dynamic. Some managers we have seen, in terms of, is there anything different that would mean a more sustained higher level of drawings going forward? I don't think there's anything material going on that would significantly shift that. There are still some managers that choose to change behaviourally how they're using these facilities. So we still do have some clients who don't necessarily, utilise them for the full 12-month period, or plus, some of them are still at 3-6 months. They might be shifting that out as they think about, actually, there is opportunity here to be using these slightly differently. So I think with some managers, we are seeing a little bit of change of behaviour, but probably not so systematically that it's going to mean, a sustained shift in levels. But it will be interesting to see if we do start to see those continue to tick up. But I think at some point there will be a natural cap on that, because, just the sort of, the flow, the draws and the repayments of those will mean that it sort of probably caps out. But it's an interesting discussion, and we hadn't had this discussion before this, and I'm interested that we're observing, a similar thing through Q1. So it's interesting.
And Jill, I know you guys have been in market with some large ESG or large facilities with ESG components. You alluded to earlier. How are some of those conversations going with banks, as you say, where it's new to still newish or new to the market, and to a lot of different banks in appetite or questioning and access, or how is that how are people's views or impact on decisioning around that?
Yeah, so I think in summary, Jeff, I think everyone's learning as they're going. So I think we're all in the same boat where nobody has all the answers, which is quite nice. But the overarching, I think, sentiment that we found from lenders and other banks, is that there's just a general desire to support and be active in ESG. So that opens up the conversation. There's an open door there to sort of, the how, and how we're going to do it, what are we going to do around this. So, as you enter into those discussions, there's generally a how can we attitude, which is really, really good. I think the complexity is kind of how we apply ESG in certain transactions, and I don't think there's a one size fits all. So it really is, spending time with the client, understanding their ESG strategy and how that can translate into some really solid, fundamental ESG measurements and metrics that we can build into our discussions and the facility. So it's client by client, and I think it's working that through as a lender group. And I think we're all just trying to sort of learn as we go, and educate ourselves at the same time. So it's a really interesting dynamic. We're all having to work extra hard, I think, around the intellectual thinking around this, as well as the kind of how do we actually do it, how do we put it into documentation. So it's a really interesting, but I think, we all know that the investors, it's an absolute priority for our managers. It's a priority, and therefore for us as, in our own institutions, it's a priority, as well as, the fund finance market ourselves. So I think all the stars are aligned to make it happen. We're just working through the complexity of private market funds and actually how we translate that into our facilities. But yeah, I think we'll start to see that massively accelerate this year.
Yeah, that's well said. I mean, I do think it's certainly become so core and important to the entire, food chain, within our industry that, it feels good and it's exciting to be a part and see the industry make progress and to try to help perpetuate a good for overall society. Sammy, maybe let me pitch it to you. And you've got a unique view with your business into Asia, in the Asian markets, and we'd love to get perspectives on what you're seeing now there from a demand standpoint, views and predictions into to the rest of 2021.
Yep, sure. So obviously Asia continues to be of significant focus for SMBC. It's a unique market because I also think it's been, frankly, the number of lenders that have been within kind of the Asian fund finance market, I think, have been a bit smaller than you'd see obviously in other regions. But it's a region that I think, on a personal level, it's even gotten quite a bit of my attention. So I think the growth of private capital within the region is the fastest, compared to the rest of the world. I think if I had read correctly, something about like 30% increase in private capital over the past 3 or 4 years into the Asian market. And I think more so than that, I look at that market, and it's bifurcated really into two ways. We're seeing a lot of the large cap sponsors showing interest in building out the Asia strategy. Specific to us, there's a significant interest within Japan, and you would have seen a lot of the larger LBO funds interest in building the Japanese infrastructure and think that Japan is ripe for investment. So that's something that's very exciting for us, and we're significantly involved in those discussions as a potential bank and partnering with some of those initiatives. I think more so than that, we think about the broader region, and there is a really significant large cap opportunity. But one thing I do also want to point out is all of the regional Asian managers that exist throughout throughout Asia, and how we can support them. So as long as you pick the right managers, the ones with the right track record, and there's a vision in terms of what they're trying to do, there's a real opportunity to grow with them, and there's a real opportunity to build on that business. This is largely a bilateral market. There are large syndicated facilities, but because it's a bilateral market, it shows that probably over time there really is an opportunity to grow and to broadly syndicate and to look at supporting larger facilities. If I read correctly, the fund finance market in that region is about 69 billion, which represents about 12% of the total fund finance market. So it's not insignificant, but obviously there's a lot of room for growth. I'm actually in my current role now actively working on what we consider to be really the balance of the portfolio and the opportunities ahead. And it's not that the US or North America and Europe aren't of interest. They are and will continue to be of significant interest, but there is a disproportionate focus on how can we use our edge, and how can we use our knowledge of the region to really support the managers in the region. So it's exciting, and certainly a lot of work ahead of us in terms of monitoring that market.
No, that's great. And anything unique, Jill, that we should be focused on the European market for the remainder of 2021?
I think we've covered a lot of the themes, actually, Jeff. I think I expect we'll continue to see, a buoyant level of activity, with fundraisers, M&A activity. I think we will, as I've mentioned secondaries already a couple of times, but I really think that, it's already beginning to feel like, we've all sort of, a bit like ESG, we've spoken about it, and it already feels like there's a lot of activity. We've talked about secondary side, but GP-led activity and secondaries, we've already sort of seen quite an uptick there, and I think that will be a feature. And ESG we've spoken about. I think just generally, we talked about COVID accelerating, the innovation in the fund finance space, and I think we'll really see that the conversations will be slightly different as we go through 2021 as they will be in 2020. And I don't think it's necessarily new, but I think it's an acceleration. I think, the GPs and clients, they're thinking, how can they be more and more relevant to their investors and meet their sort of evolving needs and demands? They're thinking about how they can extract value and make sure that they are maximizing value through existing portfolios, and they need to be more flexible and innovative about the way they're approaching that in a highly competitive market they operate. And I think they'll expect more and more from us as lenders in being flexible and innovative. So I think those conversations, will continue with managers around how we can support them with their sort of evolving strategies and needs. So, I think that'll be interesting. And if we sit here, I'm sure to go through the quarters, we'll talk about this, but, I'm really crystal ball. So if we look back, 12 months time at the end of this year, I think it's going to be an interesting year for a number of different reasons about how we evolve as a market.
Yeah, I certainly agree. I mean, my views around the U.S. And really the global market from a fund finance perspective is that this should be a banner year. I think fundraising is going to likely hit all-time highs, or at least challenge all-time highs. I think demand for subscription product is going to be at all-time highs, if not certainly close to that. While there certainly were a number of lenders that had varying balance sheet pressures in 2020 with just rise in deposits, rise in revolver draws, and all the other exogenous events that took place, I think a lot of that has settled back down, and banks are figuring out how to deploy capital. So I think we'll probably be in that happy place again that we've been in for a lot of the last 5 to 10 years, to where both supply and demand for the product are growing in double-digit type capacity. So I think any lenders that are looking to continue to grow in this space will have plenty of product and opportunities available to them. I certainly agree with with some of the observations that you've made before, seeing GP secondary or led transactions as being a new alternative for and creating fund finance opportunities around that is just another innovation and pathway where the market is finding solutions to investor demand in unique situations. One other thing that's probably tangential to our market and really focused in the US has been the rise of SPACs that I've quite frankly found fascinating. And there's not so much of a direct lending angle or fund finance angle, but it clearly does intersect with our client base and some of the underlying companies that they would be focused on clearly have been involved in the private market space. And for those that haven't followed too closely, and in 2020 you had about 250 SPACs IPO'd for 80 billion or so in capital, which was about 6 times the volume of 2019 of the year prior, and made up about half of the total capital raised in the IPO market. And so far in 2021, we've exceeded that. There's 3
IPOs that have done for $100 billion in capital raised. And until about a week or so ago, the IPO market seemed to have a insatiable appetite for new transactions to get done. And I think it's pretty easy to read the headlines, or for anyone to suggest that it's a fad or a bubble, and point to the athletes or the rock stars that are involved in the SPACs. But I'd probably have a little bit of a view that this is a product that's here to stay, and would make a couple of observations. And one being the entrant and involvement for a lot of the large, sophisticated asset managers. So plenty of our biggest clients in the fund finance space have been setting up sponsoring SPACs and creating a program where it's not just a one-time event, and they view that as being a different prong and vehicle that they'll have to provide solutions to clients in situations. So I think as the market settles, the quality of the sponsors, and clearly the clients that we frequently deal with are sophisticated and very experienced in raising capital and seeking out good investment and partnering and providing sound investment choices are likely to be the winners, and likely to be the ones that that sustain business models around it. Secondly, I'd point to the advantages to a seller in it, where it's potentially a faster and cheaper alternative than an IPO. You can get certainty of price, a little bit easier and more of a negotiated process, and for growth companies, the ability to run a process more analogous to an M&A, where management's engaged and you can be more open around discussions of future projections and earnings on the business, enable you to achieve a higher price potentially with asymmetric information vis-a-vis the traditional IPO route. Certainly seems like an interesting and good thing for a number of companies. And probably the last fundamental point is more around the quality of the investors that have come in, and I think that's something massively different than in prior years, where whether through the pipe or increasingly on the IPO side, that your traditional long only equity investors, not just hedge fund or high net worth, the folks that have been a staple to the IPO market or actively engaged in the space. And I think if you sit back and think about it a little bit, something that's benefited us in the past decade or so around the growth in the private market and private capital and availability of private capital, the number of companies that have been able to fund their growth and to delay what ultimately would be a need or an access to the public markets or IPOing earlier has just created significantly less IPO volume, significantly less public companies than we've historically had. So I think the investment capital in that space is looking for ways to get access to those earlier stage growth companies, and candidly hasn't had as much of a vehicle to do so. So, I think sitting back, thinking about it, a little bit, clearly there's going to be some deals that work out really well. I think there's going to be a lot of them that are not going to work out, so well, and all of that ultimately is going to sort out. But creating another liquidity option for private equity sponsors or companies in general, and attractive new forms of capital into the space, kind of feels like a positive development, to me. So, in some form or fashion, I think it's going to stay, and I think it's going to be interesting to see the intersection of our clients and how they use that as both, exits or vehicles to acquire or to manage companies. So, I still think a little bit of work to do to figure out how there's a way for our market to innovate and be around that, but certainly something that that's a headline grabbing, interesting development. So I think we're getting close to close here. Maybe Jill, I'll pass it over to you for any closing comments that you have.
Yeah, thanks, Stefan. The discussion around SPAC is really interesting. I know you sort of raised it. It's not something that we see over here so much. I think it's much more prevalent in the US. But the thoughts around that are interesting, and I think you're right. It's an interesting thing for us to think about the interplay with our clients. So yeah, an interesting topic to be continued, I'm sure, amongst us as a group. So just passing comments, observations. I think it's just it's really positive that we can end the Q1 period, feeling so positive. It has been an interesting 12 months, and we continue to be not lucky. I think the fundamentals of our industry are very sound and strong. But I feel fortunate, relative to some other segments and sectors that are still under quite a lot of pressure, that we have a really buoyant outlook. So continue to have positive thoughts about the year ahead. Yeah. And so yeah, just a positive outlook really, and my passing thoughts really, Jeff.
What about you? I'll give you the last word.
Sure. No, I think it's a pretty common theme that year over year I've been saying. I think it's about building relevance with clients, right? So my biggest focus going into next year is how do we make sure that we are being effectively solutions oriented and not transaction oriented. I think we all know that there's plenty of fund financing opportunities, be it traditional subscription finance or any of the other innovative products that have come, right? But I think it's about how can we look at a client and work in a more advisory context that we can help them think about their financing needs, and we can help them think about the evolution of their financing needs as they grow their funds. So one, it's about relevance, and then two, I think it's and this has been particularly important, and I've seen this in the past in my career as well. This product cannot act in a silo on its own without its relevance across the bank, right? So when we think about the implementation of new capital regulations, when we think about the efficiency of balance sheet, the velocity of capital, the importance of understanding how much balance sheet can we give out in terms of making sure that we are being solutions oriented. I think that's a common theme. So while we as a business will continue to grow, and we have an appetite to grow in the region, I want to be very thoughtful around making sure that when we speak to clients, we're dealing with clients that are relevant, that make sense for the bank, and that makes sense from a strategic perspective. Because I think in the end, that's what's going to that's what's going to benefit the most for not only ourselves but the client.
That's great. Well, thank you both for sharing your insights today. I think it's been a fantastic discussion, and I'd encourage everyone to stay around. Up next, we have a panel discussing due diligence and fraud, and I'm going to pass it over to Nick Mitra to lead that effort. But thanks again, everyone. It's great seeing you guys. Bye.
Thanks, Jeff.
Thanks, Jeff.
Jeff, thanks for moderating the market update, and thanks to Terry for the Preqin section. Next, we cover the topic of fraud in the area of fund finance. We're going to cover how banks view fraud risk, types of fraud risk, and some steps the bank might take to mitigate fraud. This is not a best practices session against fraud or other FFA or an FFA recommendation, but it's more of a roundtable discussion on the topic of fraud from different market participants. Morning, everyone. My name is Nick Mitra. I'm a managing director at Natixis and first vice chairman of the Fund Finance Association. We have an exciting lineup of panelists today, ranging from the biggest banks in our market to the council who represent them. I will let my panelists introduce themselves, starting with Kyle Bowen.
Thanks, Nick. I'm Kyle Bowen. I'm a partner in Mayor Brown's fund finance practice. We do everything from subscription lines and NAV lines to management company lines. We've been in the market for a while, and we're really excited about this panel because we think it's timely and important for all market participants to take a notice and really think about their own practices. So thanks for inviting me.
Thanks, Kyle. Next, we have Terrence Phillips from Citibank.
Terrence Phillips, Managing Director, Asia Head of Private Equity Client Coverage. Been out here in Asia for quite some time, and look forward to the discussion.
Thanks, Terrence. Tatiana Schlangman from Wells Fargo.
Tatiana Schlangman, I'm a credit officer covering subscription finance group at Wells Fargo Bank, and I'm also excited to be here.
Thanks, Jeff. Next, David Wasserman from Morgan Stanley.
It's Dave Wasserman. I'm the global head of fund finance here at Morgan Stanley, as well as the head of corporate lending on both the liquid and illiquid side. Thanks for having me.
Thanks, David. So let's start off with our first topic, which is before we get into the hows and whats and what do we do about fraud, I want to dimension this for the audience. So let's talk a little bit about how much or what level of fraud has been. We've had a 30-year track record. I've been in this business for a long time. And, from my own perspective, I see this as a relatively rare occurrence. But still, obviously, we're going to have the full conversation around it. But, from Dave and Carl's perspective, if you guys want to give some thought about the dimensions of fraud risk in fund finance. Starting with Dave.
Sure. I mean, look, like yourself, Nick, I've been in this business now for coming up on 13 years. And, the concept of risk has something that people have glossed over, very often. Usually people are very focused on credit risk, operational risk, and for the much smaller part, fraud risk, right? In the last, 15 years that I've been a part of this industry, there's been, very limited examples of investors not performing, of managers doing things, outside the scope of being allowed in the partnership agreement, or operational risk where a wire is being sent to the wrong counterparty, either on purpose or not on purpose. So the industry has been, very, weathered. It's been very strong. Banks, law firms, third-party administrators all have spent a lot of time ensuring that the right policies and procedures are being followed to reduce these levels of risk, because as we know, this is not typically what would be considered a high risk product at banks. So dotting the I's, crossing the T's has been very important, and knock on wood, the industry continues to perform at a much higher than AAA rate thus far.
Yeah, that's kind of a little bit of how we've been looking at it as well. We need to be cautious, but and there will on occasion be hiccups and bumps, but overall, at least from our perspective as a bank, generally the market has performed relatively well. And the reason, of course, we're having this conversation is because there will be on occasion things that come up. And so we need to be aware of that, but also keeping in perspective as to what has been a 30-year pretty successful track record in the business itself. Kyle, sorry, how do you look at the dimensioning fraud risk in fund finance?
Yeah, I mean, I agree with what Dave and you said, Nick. It's really a remote. I think we all view this as a remote risk, but the magnitude of the risk is huge, right? And that's what I think the market needs to understand is we need to mitigate the risk because the the type of collateral, right, is easily forged and to that effect, right? We need to mitigate that risk because it's your entire collateral pool. Whereas in some other products, the fraud risk is around the edges. In this product, the magnitude in and of itself is great. The problem on the other side and the counterbalancing act on that is always the fact that fraud is relatively rare, and we're in a close-knit community with a lot of people, stakeholders that are keeping their eye on things like this. So I think it has to be taken as a holistic approach. But from my perspective, it's the magnitude, not the frequency that we need to be worried about.
Right. So along the lines of that, so when we talk about the different types of fraud that happen, I'll just throw some things out there as to what we've seen, things such as, we've seen, or we want to talk about borrower fraud and how, as an institution, you may look at that. Do you, to your clients, or you more? How do you look at, and also a third-party fraud like changing of wire instructions, and how you approach that with different clients or from different perspectives. We'll start off with Terrence on that in terms of borrower fraud. When you look at it, is there some dimensioning around, smaller clients, this level of diligence on smaller clients versus larger clients? What's your perspective on that, Terrence?
Yeah, I think I may take a indirect path to get there. in an industry that has added so much AUM in such a short period of time, I think it's the responsibility of the banker to know their customer. And let's take that a step forward beyond the forms. As a banker in this space, you should know the IR team very well. You should know the finance team, the junior finance team, all the way up to the CFO, and you should know the partners. If you're in the space for some time, you're going to know their fund administrator, you're going to know their legal counsel, and you will have met their LPs because you either attend their annual meetings or somebody else's annual meetings. So you should have a very strong grasp on your client. And I think when that happens, and you're watching, you're not just communicating with one person, you're not taking the word of one person. You have separate and distinct teams within your organization. There's separations of functions, and you're seeing the different chains of individuals that are involved in certain communications. So whether it's a small shop or a big shop, knowing everyone's role and function and making sure that you're operating within those lines, to me, is the biggest mitigant of the risks that you can make.
No, I completely agree with you. You're kind of getting very close into what I was thinking about, which is, knowing your customer is one of the key parts to all of this. I think that's kind of where nails on the head. Tatiana, do you want to give us your perspective on, the different types of fraud risk and how you view it from your perspective from the credit side?
Sure. Again, from the fund perspective, we need to understand who those investors are who commit to the fund. And if there is anything that we have questions about what this particular entity is not necessarily, is committed in this particular fund, but the last 10 years it hasn't done so. Or we also need to ask questions about the valuations as well as, as well as the reports that we get in. So if a certain fund shows, outstanding performance in the industry where on overall, there have been some issues or even crisis the last couple of years, you need to maybe reach out to the fund and ask if those are valid reports and how those valuations are done. So it's just asking questions. The cybersecurity and third-party fraud, this is something that you have to pay attention from the operational standpoint. And again, we really pay attention to bring in the consistency to the processes in the bank that we will pay attention to. But I agree with Terence. A lot of that goes to the point where, from one point of view, you have to know your clients and know who to reach out to. From another point of view, you really need to pay attention to a strong operational base at your institution to ensure that there are various checkpoints to ensure that something like that doesn't happen.
Right.
Really quick, if I could just jump in, and Tatiana brought up a great point. If you look at the portfolio, and again, going back to a space where we have added tons of AUM, everybody's out looking for their new deal. How do you make sure there's alignment with the portfolio of the fund manager you're working with, the GPs of the fund, and your organization? Because I think when your firm's going to get sideways, when a credit's going to get sideways, it's because the credit does not fit your organization and your shop. When you know the underlying portfolio companies, when those portfolio companies are clients of your shop, not all of them, but some of them, when those GPs are clients of your institution, there's a much greater knowledge of what that firm's up to and what the strengths and challenges are for that firm. So, going into the portfolio, this industry shouldn't just be institutions adding AUM because they make a nice profit off it. There should be some alignment and strategic with the institution. I think that adds another layer of risk control.
Yeah, no, absolutely, Terence. I mean, that's and Tatiana's mentioned the know your customer part of it. The way, for example, we operate at our bank is, we almost never will do a new startup manager, but that doesn't mean that's not something that shouldn't be done. It's just our strategy has been to focus on clients where there are multiple touch points, which indirectly or directly, you could say, also impacts your fraud risk, because there are 5 persons at the bank talking to the same client, and then we have an internal discussion, as to how we should proceed in terms of the overall relationship. But 5 different people talking to different parts of the same borrower help, rather than having just a one-off conversation, just say on a fund finance product. Let's talk a little about the warning signs and red flags on fraud, and steps you take to protect your institution or your clients. Kyle, why don't you walk us through this from the counsel perspective, and then we'll go to the banks and see how they look at it.
Yeah, as we just discussed, there's multiple types of fraud that could happen, right? Like there could be fraudulent subdocs. There could be funds that violate pay-to-play policies. There could be funds that violate limited partnership agreements, like transactions with affiliates. Funds could fail to report capital calls and bridge investments, so maybe not trying to ultimately come out ahead, but basically tweak the system so it works for them. And so from a counsel's point of view, we look at different things to kind of mitigate each one of those, right? So subdocs, we're looking at the subdocs to make sure they're fully formed, they're fully compiled, they look on their face to be inconsistent with what we've seen from that investor, in prior funds. We rely a lot on, working, I primarily do lender side work. We work with borrowers counsel, make sure that they were involved in the process. If they were not involved, if it was done by the IR team at the funds, making sure we understand that process a little bit. That's what we would do on the subdocs. When we draft the credit agreement, we make sure that there's a requirement to have simultaneous or prompt notice of capital calls, and the financial reporting. There's often requests to only get that when the investors get it, and we understand delays happen, but from a bank's perspective, we think that you need definitely to have your reporting requirements kind of tightened up in the document, and you can always waive those at the time. But funds that are trying to tweak their reporting or delay reporting to commit fraud, right, it can often be that risk can be mitigated by tight controls in the credit agreement, and making sure that what you have when you receive it, you actually look at it and you tie it out.
Got it. I appreciate that, Kyle. Terrence, from your perspective, when you're looking for warning signs or red flags or things you take to protect your institution?
Yeah, listen, I think we do a lot of syndicated deals here in Asia, and you do see new players coming into the space. So I think one warning sign for me is when you have a pretty industry standard term in an agreement, and it starts to bend. And then, you start to remove something else. And then what is any one of those given terms, they can come or go, right? But when I look at the totality of what you've done in a deal, whether it's the terms of the deal, whether it's the covenants, I think it's always good to take a step back and look at the totality. And then from an industry perspective, making sure that you're not doing things that are high risk, that are going to lead to a fund counsel saying, oh, hey, look what these guys did over here. Let's add it to this deal. Now we're going to add it to this deal. And then it becomes a standard, because that brings the strength of the document for the industry down to a much lower level. And I think we all have a responsibility from the counsel side to the client side and the bank side to make sure that the quality of the document remains high, even though we all want to do business.
I would agree with that, absolutely. Tatiana, from your perspective in terms of warning signs?
Sure. I would like to highlight the importance of due diligence, and it should be done in person if possible, specifically for the new timers or first-time funds. I know in this environment it's more difficult, but if possible to see, look at the team, look at the management bio. Is there anything that raises questions? Look at the offices. Sometimes if an office location is in a random shopping mall plaza, is this a real location? Look at how people are behaved. Sometimes at the meetings, it's possible that who are representatives that come represent the funds. Do all of them really work for the same firm or not? Even the financial statements and PPMs and other documents, you can see how the quality of those documents is, and and with its first-time managers, is it really an established firm or not? So again, I would just highlight that due diligence is still important, and especially financial institutions should continue doing that if possible once we're out of this more enclosed environment.
Right.
Tatiana, a fabulous point. Sorry. As you're seeing first-time funds, we saw a lot of that in Asia from 2002 to probably 2008. But the new fund manager coming in, when there was spinoff, that was always great. You created two clients out of one, but understanding the genesis of why one partner left a firm to start that new firm. What dynamic went down, and usually it's all very healthy. It's there's growth and maybe just different opinions and views on how to make investments, but understanding why that partner spun out, understanding where they came from, and then when you're looking at a new fund, listen, a new fund is not going to start day one typically with the highest level of institutional investor, so you should be looking at some fund to funds in there, from bank side, you should have a great relationship with the fund to funds, and be able to understand that new firm, that new partner. So just a little expansion on Tatiana's point there.
No, absolutely agree. Dave, from your perspective, warning signs from your perspective and red flags that you look at or things to protect your institution?
Look, one thing that goes a little unsaid is, there's a specific tiering of managers that everyone has when performing their due diligence. Someone that is a public company that has a separation of church and state when it comes to fundraising, investor relations, internal counsel, portfolio manager, and then treasury. The diligence on those managers are just not going to be as deep as a first time or second time manager, right? I don't want to sound sophomoric, but sometimes I look at the biggest risk being more the operational risk, and it's sometimes hard to just make sure that your back office is putting together the right set of policies and procedures and then actually following them, right? I think we work in an environment where it's been really busy over the last 3 to 5 years. And during that last 3 to 5 years, people have taken shortcuts. Junior bankers and senior bankers alike have maybe loosened up their internal steps and diligence and relying more on the lawyers. Everyone could be a little bit guilty of that, to be clear. So the policies and procedures that were put in place early on sometimes just need to be reviewed maybe once a year, thought about how the industry has changed over the last 1 year, 3 year, 5 years. When it comes to the concept of first-time managers, I think Terrence brings up a very good point. Anytime I've ever done business with a first-time manager, I've known the principal in a prior life, or at least know of him or her in a prior life. And I think that's incredibly important to know their background, their pedigree. One thing that we've done before for first-time managers, my prior life, was getting a full roster of the contact information of the LPs pre-close and doing some spot checks. Now, is that going to work with the tier one manager? Absolutely not. But getting that list is not always just for diligence. Sometimes it's just, hey, look, in a worst case scenario, when you need to issue capital calls, you just want to update a roster of where to send those capital calls, because it could be 3 or 4 years, dated, and the email address might not be active, and you have a rep in there too constantly up. So, I don't want to sound like, like this is easy, but sometimes people just need to follow the policies and procedures and do the right callbacks when capital goes out, and make sure that when a capital call is made that people are checking the wires that comes in before they send it out, and it's standing wire instructions that's been sent out 5 times before. Right. Things like that are incredibly important and should be reviewed with operational staff and chief legal counsel and risk officers of the banks to make sure that they're updated for reality.
Right. No, totally agree. And as you talked about here, we've talked about the tiering of the clients. Absolutely, there's a different level of diligence for, as you said, a tier one fund manager who has multiple levels of internal controls and staff that can go into the hundreds versus a startup manager. Some of the things that we also look for, it's not necessarily a warning sign or such, but as you said, the separation of church and state. The investment team is one, it's not making the same decisions in terms of the cash management, in terms of capital call notices and such. One of the other things we look at on there is the existence of a fund administrator, which effectively does the same as you talked about, the separation of church and state, the separation of the investment team from the operational aspects of the business, which I think. I'm going to throw
out one more thing I think is really important, and especially for the people that's been in this business for a long time. Your gut instinct when something doesn't feel right and you can't put your finger on it is incredibly important. And I've been in 1 or 2 circumstances where I could not necessarily point to what made me feel uncomfortable, but just a summation of things that were said or people's backgrounds or, documents provided to me. Again, couldn't point to one thing, but just my gut instinct told me it was a situation that maybe I could not say was a fraud, but was something I felt uncomfortable with and did not want to be a part of in regards to the financing. Because my standard is always going to be, if there's a 1% chance that this is not going to go right, from a lending perspective, it's not something I want to be a part of at any rate, at any spread.
Yeah, and I agree with that, Dave. I think, one thing that when I get nervous is it's death by 1,000 paper cuts, right? It's a lot of little things, and you have a gut feeling that something might not be right. 9 out of 10 times, it's probably you're being overly cautious, but there's really no reason, in my opinion, to not get those good answers to market standard questions. So if you're seeing abnormalities, right, run them to ground and not necessarily, just accept them as something that we need to move on to get the deal done.
And this goes to Terrence's point, right, which is, if you've got a document which has relatively market standard types of provisions in there, and you start to see that being watered down, that's clearly something to be aware of. And just think about, there could be specific circumstances why a client is reflecting that, and they could be completely legitimate, but at least be aware before you go into this and saying, okay, we normally do this, but we're going to do this over here. So we kind of touched upon this question, but what have we learned from past experience? Any of the panelists want to add to things that we can talk about from, if when we're coming back to where we were and how we're evolving, which is our next topic, which is how we're evolving from here. What have we learned from past experience on this?
I would like to add to that, Nick. I think what's important really is to have a cross-reference within your institutions. So, for example, if you have the same client which is already being banked by other lines of businesses, or other law firms that you already seen in other in other facilities, and then you can have a contact that we can reach out to, or maybe the investments that they make and they already you already lend to those particular companies. So it's like a big web of information, and not being lazy, but and reach out to all your points of contact and ensure that there is cross-reference.
Right. Absolutely. So that gets us to our final conversation topic for today, which is now let's start looking into the future as to what evolution we might see in the industry and going on. Also, part of this is what type of conversations are happening. It's not meant to be as, this is what everyone should be doing, but just what are people thinking about? What are the concerns being raised, and how are some of them being mitigated? Let's start with Kyle.
Yeah, sure. I mean, I think one thing that the product was really designed, before investor portals were very common, right? And we actually have paper-based thought process around the collateral and monitoring the collateral. I think a lot of banks are looking more at view-only access to portfolio to investor portals, seeing everything in live time as it goes out to the investors, but also being able to see when people open things and that goes to a point. One thing that I think that a lot of banks are talking about, and I think it's a good idea to mitigate the risk of fraudulent subscription agreements, is in Cayman and in Lux, we already send out investor notices for perfection purposes. We think that the market might say, even if we don't have to do it for perfection purposes, we're going to start doing that for all funds, Delaware funds. And what that does is it allows you to see that a notice went out to the investor. If the investor is fake, right, they would have to, the fraud has to get a little bit broader with, a fake email address, and then, one concern about the subdoc forgery issue is someone will change a $5 million commitment to a $50 million commitment. So if you put in those investor notices, the actual commitment of the investor, that's also a double check on that as well. And so those are two things that I think the banks have been really thinking about. Right. And I think both of them are good ideas.
Right. And just from, I guess, our borrowers' perspective, we know some of our borrowers sometimes for us to get into their relationship with the investors, and that's always been a point of conversation with our managers. So how, or is it too early, or how do you either see that evolving, or how has it been evolving? How have your conversations been so far on that point?
No, I think, that's exactly right. No one wants the bank calling the investors, especially investors, every investor. And I don't think the banks are set up to do that as well, to be perfectly honest. And that's what's really good about this investor notice technique, in the fact that it's still the fund sending it out. It's a double check. It makes the fraud harder to accomplish in the fact that, there's a double check on the email addresses and the read receipts or the investor portal, but it's still all controlled by the fund or the fund's counsel. And that I think gives the fund a little bit more comfort that a bank and their investor aren't talking directly. But on the bank side, I think it really helps you understand that this is real. And so I think it's a good compromise. And then with the investor portals, just having read-only access, I don't think should be problematic from my perspective.
Correct. Dave, from your perspective, how do you sort of see this space evolving with different events that are going on?
I think Kyle really kind of encapsulated most of it. I would say the majority of the sponsors I'm facing, try to use the investor portal technology. Doing the notification is something that I don't expect to be a big lift. Look, I know there's been certain circumstances in the market that dictates, different preparations or different methods going forward. But honestly, for me, I typically play in the higher tier 1, tier 2 manager space where the firm has a pretty deep and long relationship. Then I don't think, materially speaking, that my platform is going to change. Maybe at the edges on a few things, but for the most part, I don't expect the material modification to occur on what I'm doing day to day.
Got it. Tatiana, from your perspective, in terms of evolution, that's the way you see the market evolving from here.
Sure. I would like to highlight three things. One is it shouldn't probably happen for all the sponsors and funds, but whether the pledge account, the pledge bank account should be held at the lender. I know it sometimes brings additional operational complications, but that's one option. The second one, more maybe tiering of the requirements for tier 1 clients versus the tier 2, tier 3 clients. Again, if we are comfortable with certain things, and with tier 1, maybe tier 3 is going to be more rigorous. And then the spot checks. So the spot checks would be, randomly selecting certain investors and reaching out to them.
Right. Now, Terence, from your perspective, how do you see the evolution of the market of this area?
Well, listen, in Asia, we've been sending notifications because most of our funds are, structured through Cayman Islands, if not all of them. So I don't see much change in that respect, but I think internally within all of our own shops, there's a separation of functions. Maybe show a little more patience and respects for one another. That when the risk guy is pushing you on something, take it through another couple levels, right? Make sure you're looking into it, going a little deeper. It doesn't hurt. KYC pushes a little harder. It's okay to challenge the client, and we get in these competitive situations, and you just got to remember it's okay to challenge the client, challenge your own team, challenge your counsel a little bit. And so I think that's where the immediate reaction and the best response can be is if we all look into our own shops and just, push a little harder. As we talked about, there has been very few examples of fraud in the last 30 years. So if we're all just paying a little bit more attention to the detail, we should be just fine.
Thanks, Terence. I think you kind of brought together like one of the key points there, which is the industry has done, just to reemphasize, very well. And there are very, very few instances of fraud over 30 plus years of a track record. So let's keep that in mind. Lots of things, as we talked about, that can be done, that should be done. But our industry has performed very well over the last few years. So with that, we come to the conclusion of our seminar. I hope you found this discussion as interesting and fascinating as I did. It's timely, it's topical, it's all something we should be thinking about. I'd like to thank all of our participants on the panel for their time and sharing the views. I'd also like to thank Terry Hatton and Preqin for the Preqin update, and also Jeff and his panel for the market update. As the market continues to evolve, the FFA is going to continue posting new and relevant sessions. One of the ones that is coming up is on LIBOR transition. Please stay tuned for that. As always, please do not hesitate to reach out to an FFA board member or go to the FFA website for updates on our upcoming programming. Thanks again for watching. We hope to see you at an upcoming FFA event.